Okay, welcome everyone, and thank you again for joining us today. My name is Matt Cornwall. I'm one of the Associate Directors in Student Services in the Saunders College of Business. So we're really excited today to bring you a webinar under our Finance and Accounting Department titled Active versus Passive Investing in Tax Implications Associated with that. I just want to present just some logistics with respect to the session real quickly, and then I'll turn it over to Dr. Archana Jain. So there is a Q&A function in the bottom of your Zoom webinar feature here. That's where you can ask any questions you have, and then we'll get to those as we work through the session. I know we have some scripted questions that we'll work through as well. If you need captions, if you go down to the settings screen in the bottom there, you can actually activate those as well. It's not perfect. It's not, we're going through this and it's automated. But again, if you have those, and you can certainly support those. I also just want to mention that today's session is brought to you by our graduate programs in accounting and finance. So we have an MS program in accounting and analytics and an MS program in finance, as well as obviously undergraduate programs in accounting and finance as well. So just keep that in mind if you have questions on any of those programs as we move forward. So I'll turn it over to Dr. Archana Jain.
Thank you, Matt. So, hello everyone. Welcome and to join the seminar on active versus passive investing. So we have a very interesting questions lined up for you, and then feel free to add them as you go. So today we have Jim with us. Jim is the co-founder and president of Alesco Advisors, and he has 30 years of investment advisory experience in this role as the leader of the firm. He's also actively involved with business development and client services, and he's a member of the firm's investment committee. And before this, Jim was president of Clover Capital Management. It's a Rochester-based New York-based investment advisory firm. And earlier in his career, Jim has also worked as a financial analyst at Xerox, an audit and tax accountant at Pete and Marvick Mitchell, and was a large system sales representative for IBM. And he's also the recipient of 22-23 Distinguished Alumni Award for the Saunders College of Business. So we are happy to have him here. Along with him, we also have Judy Rossiter, and he is a senior portfolio manager at Alesco, and he's a 98 graduate of RIT finance program. So they're both alums of RIT. So we are very happy to have you guys here. Again, my name is Archana Jain, and I am the associate professor of finance, and I'm the department chair for finance and accounting. Okay, so should we get started, Jim? Are you ready?
Ready.
All right. All right. Sounds good. So we first, as we said, we talk about active versus passive investing, and should we try to beat the market? That's the theme. So before we get into the idea of active versus passive investing, let's talk about how is the access return conceptualized and calculated in the field, in your industry. So,
yeah, happy to do that. So just delighted to be here, by the way, early afternoon. And as you mentioned, Archana, Jody is an RIT alum, class of 98. Jody is a senior portfolio manager with us. And the primary reason Jody is on the call is in case there's any moderate to difficult questions. He'll be able to answer those. The easy ones are my expertise. So just kind of let's get things kicked off. I think it's probably good for the audience to have a little bit of a history of index-based investing in terms of how it came about. And really it's relative to how long people have been making investments in the capital markets. It's still a relatively new concept, even though there's a very large percentage of monies are invested in the marketplace are deployed using passive or index-based investments. So specifically, there was an economist, Paul Samuelson, who's a Nobel laureate for economics, and he was a professor at MIT, the other IT university. So he was very well known and widely followed in terms of his commentary as it relates to economic factors in his day, but he had questioned out loud. He called it the big challenge for Wall Street, which was questioning whether or not what he referred to as the gunslingers of Wall Street were really adding any value for all of the research work that they were doing in the selection of individual securities. And he encouraged someone somewhere, and that's exactly how he phrased it, he would hope that someone somewhere would create a broadly diversified basket of stocks that were just purchased and held, and that could be used as some form of a benchmark by which the gunslingers of Wall Street, the active managers, would be able to measure the value that they add. He referred to it as their prowess. And so what just so turns out that considerably earlier in 1951, John Bogle, his thesis while he was a senior at Princeton was on that same topic, questioning whether or not there was any value added in the selection of securities relative to a broadly diversified, unmanaged basket of securities. So when Bogle saw in I think it was 1976, that was 1974 was Samuelson's article that was published in the Journal of Portfolio Management. Bogle read that, and that's when he decided he had to move forward and create the first index fund. And he was working at Vanguard at the time, and so he started what was the S&P 500 index fund and created replicating the Standard & Poor's 500, which had an index that had been created. He actually created a fund, and so what that turned out to be the beginning of the passive investment management industry. And as we speak, to give you an idea of just how powerful the concept has been, the low end of the range in terms of U.S. equities that are estimated to be passively managed is around 14 or 15%. And some estimates are as high as in the low 40 percentile. We think that's a little too high, but certainly it's a very meaningful amount of money is now invested in passive or index-based investments. So back to your question, if any of you can even remember what the question was, the question was, how is value added? How is that conceptualized? And so that really, if you think about what's going on here, is the idea is that the active management, those who do it for a living, the fact that they're doing it for a living means they're getting paid for that. And so for an investor, based on how much you have to pay for individuals to make individual security selections, are they generating a return premium relative to what one could get in a much lower priced passive or index-based investment? And so the differential between what a manager makes net of their expenses, higher or lower than the benchmark, that would be the return premium or deficit. Oftentimes the deficit is referred to as value destruction in terms of the portfolio's outcome. So the conceptual part is, can a manager do better than a particular benchmark? And the way it's measured would be those returns that are generated in theory that are the value added would be those returns that are generated above the return of that benchmark. Now, Jody, do you anything you'd like to add to that? Jody?
Sorry, I had to unmute.
Yes,
No, you're doing great so far, Jim.
Okay.
Okay.
Very good.
So,
And
yeah.
Archana, did that answer your question?
Yes, that did. So the idea of conceptualized return is basically the return over and passive indexed fund. So those of you who are not familiar, S&P 500 is the collection of the 500 largest companies which are traded on New York Stock Exchange. So instead of what we're talking about here is, rather than picking a stock, which is like Apple or Google or Microsoft, you pick a collection of 500 companies and invest in that. So you're investing in fraction. So So that's passive investing, where I'm not investing, not spending time to find out, should I go for Apple versus Microsoft, where I'm just picking a collection of 500 firms, and the idea is which one is better. So that leads to my next question. In general, what is the other differences that, in your opinion, between active versus passive investing? And what are some of the common tools that we can use to do this fractional investment in the market?
Yes, so the stock market and the bond market have a variety of different flavors. Archana, you outlined the S&P, use the S&P 500 as a proxy for large companies headquartered in the United States, publicly traded. In effect, the 500 largest companies that are publicly traded. There are some, not, that's not exact, but it's pretty good assumption. And so there are a variety of different other parts of the market. So you have medium-sized companies and there are benchmarks or indices that reflect that. So a very well-known benchmark for medium-sized companies is the S&P 400, cleverly named, right? And then there's the small company benchmark, the S&P 600. And then there are also benchmarks for microcap stocks. There are benchmarks or index-based indices that represent different parts of the bond market. Internationally, also the same with regard to developed market international investments as well as emerging market international investments. So what I'd like to do is talk about the difference between the two. I'd like to just, if I could, share my screen here, and I think I should be able to, oh, can I do that now?
Yes, you should be able to share your screen.
Okay, let me see here. No, I don't know who.
Okay, now try, sorry.
All right, good. So what I'd like to do is just take you through, a little bit of why index-based investment makes sense and the theories behind that. And so, and then we could talk a little bit about the actual outcomes. But when we talk about active management, what we have is we have a whole bunch of very smart people out there who are paid big money to generate returns that are higher than the benchmark. And that's a very good thing as it relates to passive investments and index-based investments. And that may be somewhat counterintuitive. The reason it's a good thing is that the markets, because we have very smart people buying and selling securities all day long, there's great efficiency in terms of the pricing, the price discovery for a particular security. So you mentioned earlier, Archana, Apple. So let's say at any moment in time, let's say right now, there's a 20,000 share trade being done on Apple. One institution is buying Apple stock, the other institution is selling it. Well, what you have is you have very smart security analysts on both sides of that same trade. You have a very smart analyst or a particular analyst who's done a lot of research on Apple stock, and they've decided that they want to own more Apple stock or maybe buying it for the very first time in their portfolio. Who's selling it? Who are they buying it from? They're selling it from another very smart analyst who's concerned about the future returns for Apple, that think that they may not be as attractive. And so what you have is the PhD from Harvard is decided to buy Apple stock, and the PhD from Yale is decided to sell it. So we know with a high degree of confidence that the pricing for that security is really a good market value that reflects, in effect, the consensus thinking of the best and brightest of Wall Street at any point in time. The issue is that both of those firms are charging their clients a fee. And so if we add up the returns for Apple stock over the next year, we'll say, over the holding period that one firm has it and the other one sold it, the net return to the investors of those two firms combined is below the return of Apple. Because if you just, right, because both firms, there's no change net. Apple stock is owned in the market, but both firms are charging their clients a fee. And there's transaction costs as well in terms of brokerage commissions and a bid and ask spread as well. So the net return on Apple stock is actually higher than the net return of those two firms on average are generating for their clients. And so what happens is when we look at, and what this chart shows a little bit on part of the concept here that reflects that, is the right-hand part of this chart, the circle, shows that asset allocation. In other words, it's how your money is allocated in the capital markets that are far more important in terms of the outcomes than the security selection. So coming back to the idea of Apple stock, that Apple, it's more important that you own stocks and that you owned Apple stock than and held it throughout that period of time. You're likely to do better than the average investor out there that would be buying and selling that security. And that's really kind of in a nutshell of the difference between active and passive. And the same thing holds true in other parts of the market. The study that is referenced on this slide is one that goes all the way back to 1986, but it's a seminal study that was done by Brinson, Hood, and Biebauer, trying to determine what are the key attributes, what are the key factors that go into the variability of investment returns. And the takeaway there is asset allocation, as this study shows, creates 93.6% of the profile of returns in a portfolio, where security selection, market timing, costs are much smaller. And most people would argue that market timing destroys value, and certainly we know costs are negative. Our proposal, and what we believe the academic research supports, is that security selection, surprisingly, also destroys value. We'll show you some data to that effect a little bit later. So one of the key attributes of passive investing is simply being in the market. That when you own equities and you own this broadly diversified portfolio of equities, as I tried to explain earlier, that you're getting the best and brightest thinking out of Wall Street as it relates to price discovery. So that becomes very efficient. But because you're not paying the high fees for the management, the investment selection, you have a lower cost and therefore do better than the average investor in the market. So a little bit along those lines, using a couple of common areas of investing for equities. If you look at this chart, the first thing is that most active managers, I'm going to show you some data, even though they're paid a premium fee to beat the market, most of them aren't able to do that, the vast majority. So, and we'll show you the specifics. But what this points out is not only do they fail to beat the market, that the downside of their underperformance is considerably greater than the upside return when managers do outperform the market. So let's say that there was some form of lottery ticket upside associated with picking a winning manager, a manager do better, and that the tremendously higher returns that would be generated if you picked the right manager. That would be an argument to say, all right, maybe it's worth taking a shot. But what this shows you is that that's a very unlikely scenario. The left-hand part of the slide looks at the S&P 500. So that would be, again, the large company stock index, U.S. equities. And this shows you the 10 years ended September 30th, 2021. And this data, there's always a lag in terms of when it's actually available, but you'd see numbers very similar if we were using September 30th, 2022. What this shows you is that 84% of the managers, that underperformed versus 16% that outperformed, but their underperformance was by an average of 2% a year, versus the managers who outperformed, they only outperformed by a little over 0.5% per year. So you can see the downside relative to the upside is quite substantial. And then when we look at the S&P 600 index, this would be small company stocks. We see the numbers are even more broadly diverse. 91% of the managers failed to beat the benchmark and underperformed by 2.14% per year, versus 9% of the managers who outperformed by less than 0.5%. So
yeah, this is very interesting data, Jim. So this outperformance that you're showing here, 0.55 and 0.47, I'm guessing this is before the trading cost. So once you take the trading cost, is it like a negative number, 0, or basically it's not significant anymore?
These numbers would be net of trading costs, because
Okay.
this is looking at the returns from mutual funds.
Okay.
Mutual funds. So these are
Yeah.
net. They're also audited data. Mutual funds
Right.
have audited performance. So this is we think a pretty good apples to apples.
Okay. This
Want
is
to
good.
get
And
into
I really liked your example of how you were talking about, for if you look at collectively for two companies, the return of Apple is less than what the true return of the Apple would be if they were not changing hands because of the transaction cost. So I see you're getting into are you getting into the taxes yet? Because I wanted to ask about what are the tools? So if I take your word that there is no point in this active investing and looking for stocks, what are the different tools of how I can invest in the passive funds? What are my options here?
Yeah, so the two primary approaches would be what most people are quite familiar with, which would be an open-ended mutual fund. So there are index funds. Vanguard is a very well-known provider of that, and but there are all kinds of other index funds out there. And then there are also exchange traded funds, which is an area that is not as long lived as the mutual fund offerings, but has some distinct advantages.
Okay. And do you have a preference? You're in the ETF field, so what are the advantage of trading with ETF compared to trading with mutual funds?
Yeah, there's a few advantages. The primary advantages from our perspective is that they're very tax efficient, and so we would typically use in a taxable portfolio. We would typically lean very much towards exchange traded funds, and the reason they're more tax efficient is they're not obligated to distribute their capital gains to their shareholders, versus an open-ended mutual fund. When there are capital gains that take place in the fund, those capital gains they flow through directly to the shareholders. And the real problem there is, if you look at 2022 as an example, is you can have a down year. You put money in, in January of 2022, you put it into a mutual fund, and the market is down throughout the year. You end up losing money. But in order to pay for redemptions, the mutual fund sold securities that had gains that were generated in prior years. Those gains, those taxable gains, flow through to you as a shareholder, even though you lost money in 2022. You got to pay capital gains taxes on that. Now, the offset is you get a stepped up basis, so your future gains are reduced. But from A, psychologically, and B, from a cash flow standpoint, it's not particularly pretty scenario. Exchange traded funds do not distribute their capital gains, and therefore it gives you you have the ability to defer those gains until you're ready to recognize them, until you're ready to sell a stock. Sell the ETF. So it's much more analogous with buying how one would be taxed with buying an individual stock. Jody, anything to add to that?
I was just going to explain just very high level the mechanics behind why that is, and that's in the mutual funds, when they do have redemptions, or if they're the active manager decides to reduce Apple and increase Microsoft, when they sell those securities, either for the redemption or a change in philosophy of that security, those capital gains are stuck in that mutual fund. And it's regardless of how long you've held that mutual fund. So if you've held that mutual fund for 10 years, you get that capital gain. If you buy it, the week before that capital gain is distributed, you're subject to that same capital gains, regardless of how long you've held that fund. Within ETFs, there's a mechanism where instead of selling those securities for certain redemptions, they have the ability to basically in kind transfer the securities to the other participant, to the other party. So instead of selling, say you had a very large redemption, 10% of your fund left. So the ETF doesn't necessarily have to sell 10% of its holdings. It can take 10% of a basket of those holdings and take 10% of those and transfer to those through another market participant. And so they don't have to sell those securities, and so they're not realizing the gains. So that's a very important note, kind of behind the scenes. iShares actually has a great video that goes through, if anybody wants to dig deeper on that. Out on YouTube, they have a great video that you can search for, or I can send you the link. It's iShares flower video. It basically takes an analogy of ETFs and it boils down to a flower shop, treats them as different flowers, packaging them together, taking the different types of flowers, put them together into like an S&P 500 index ETF, and kind of how that process works. It's a great video. It's probably about 10 minutes long, and it's wonderful.
Yeah, it'll be great if you share the link. We'll be definitely interested in watching that.
Yeah, I'll pass that along for you.
Right. Okay. So you briefly talked about the tax implications. So now coming from again investment side, that okay, so I understand that active investing is not as useful. I should go for passive investing. There is no beating the market really. So then now coming to what is the role of financial advisors? In other words, why do we still need you, I guess, is the question, right? That what services you can provide in this sense, when we are choosing the passive investment route?
Yeah, absolutely. So the first thing is that when you think about if any of you who are watching today, listening today, if you turn on CNBC tonight as a good example, and you pay attention, you're following the financial media, you'll be there's all kinds of recommendations that are going to be made to you in terms of where you should invest, how you should invest, different products that are being advocated. So what happens is there's a tremendous variety of different offerings and concepts and philosophies that are out there that if you try to do it on your own, most people are really going to be confused and are also very likely to get caught up in the mindset of the financial media. The financial media, keep in mind, is a business. It's not really an independent reporting mechanism. The CNBC is very much dependent upon its advertisers for its livelihood, for how that organization makes money, as is most of the other financial media. And so what they're going to do, of course, is they're going to advocate or at least allow to be broadcast positions that may not be in the viewer's best interest. So what a financial advisor, what we are, is we're independent. Alesco Advisors is an example. We have no proprietary investment offerings. We don't generate any revenues other than by our fees, which would be for most. It would be very similar to how most lawyers get paid or most accountants get paid. They're not peddling a product. And so what happens is our service, therefore, because it is independent, it is unbiased. And it's also we have an investment philosophy that suggests, and we have implemented in a way that reflects a great deal of discipline. So what does all this mean? Well, look at the last 6 months here, last 5 months. At the end of September of 2022, when the markets were bottoming out, if you look at the financial media, and if you look at some of the big wirehouses and Goldman Sachs as an example, Morgan Stanley, JP Morgan Chase, big organizations that were telling their people who were listening, stay out of the market. We've got a long ways to go before we get to the bottom. Get out, right? Well, that was actually the bottom of the market so far. We've had a tremendous recovery from that point in time to where we are today. So what did we do? What are we doing at Alesco? Well, we're rebalancing our portfolios. Our clients have a target allocation that we help them identify based on their objectives. How much of their portfolio should be allocated to stocks? How much for bonds? And a large part of that decision, it rests upon how long we're investing the money for, as well as what's some of the other specific needs that the client might have. All that gets reflected in how the portfolio is allocated within the capital markets. And then we have the discipline to stay the course. And we don't have a lot of clients who call up and are express that they're fearful, but we have some who have done that recently, and last fall is a good example. And we tell them to stay the course. Things are going to be fine. We don't know when things are going to turn favorable, but they will. And remind them that they're not investing the money to pay the heat bill next month. They're investing the money to provide for them and their families for decades to come. And so that helps them stay the course and get through these more troubled times. So the needs that we fulfill are A, helping clients understand how to structure the portfolio to begin with, B, maintaining the discipline through thick and thin, and then C, managing the portfolio, and we talked about taxes a little bit earlier, in a tax efficient manner as well. So exchange traded funds, as we mentioned, are very tax efficient, but the overlay to that are people like in our firm, Jody Rossiter, who are looking at taking advantage of downturns in the market to harvest losses, to take tax losses, and to also looking at how to best reposition a portfolio for the market's recovery.
That's great, Jim. So what I see this as a role of financial advisors, and first of all, who do not know what to do, you tell them what to do. Also, people like my husband who are overconfident, tell them what not to do. Discipline is the key word, because once you start making money, you think like, yes, I'm always going to make money, which is not true. So I think it's a good idea to use financial advisors to keep you disciplined, that you don't over allocate in particular industry or sector or whatever asset class, for example. So that's very useful. So you mentioned,
I was going to make a comment that just I can't remember who it is. It might have been Paul Samuelson, but one of the a very famous quote was, investing in the market should be like watching paint dry or watching grass grow. If you want to have some excitement, take $800 and go to Las Vegas.
Yes.
So
that is very true. Yes.
But you do want, it is important that you don't get too far out over your skis with getting overly excited when a particular stock or part of the market's doing well and you think, boy, I've got this figured out. I'm the rocket scientist. You very likely are going to be eating some humble pie in relatively short order. Yes. What's much more important is having the right, it's okay to take a portion of your portfolio and roll the dice a little bit, but your serious money should be invested, we would argue, in a manner similar to how Alesco handles things.
Yeah,
okay.
And I want to point out too that part of the role of an advisor, just selecting, I want to have a 50% allocation into large cap just by an index fund. Index construction is very important. There are large differences between the different indexes. There's not an industry standard for what the definition of large cap, mid cap, or small cap is. So each index provider, S&P and Russell, more on the international side, they do have some domestic, but you have MSCI and FTSE. How they define the difference between large, mid, and small can be different, as well as what their criteria to make it into the index can be very different. For example, just comparing S&P and Russell, for the Russell 1000, they just take the largest 1,000 companies, and that's the Russell 1000. The S&P 500 does not take just the 500 largest companies and make that the S&P 500. They have some additional screens on there, and they actually use a committee for getting companies in and out of the index. And most of those criteria are pretty immaterial between the Russell and the S&P. But one major one that S&P uses is a earnings screen. So they look for companies that are profitable over the last year and in the last quarter, where Russell does not have that. And that can lead to some big differences in the index construction and what those names make up. It's even more prevalent in the small cap space, where you have more companies that are not profitable. And so that can lead to very big return differences between the Russell and the S&P indexes. For example, the Russell 2000 in 2020 outperformed the S&P 600, both small cap indexes. It outperformed by 8%. That's a pretty big difference between two index funds trying to represent the small cap space. And the flip was reversed in 2021, where the S&P outperformed the Russell small cap index by over 9.5%. There's reasons behind that. After the pandemic in 2020, these unprofitable companies did very, very well in that environment, and that reversed. So that explains it. But just picking a large cap index, it's not quite as simple, and just kind of knowing what you own and what that index does can be very important. And that's one of the things that I do at Alesco, is kind of understanding the difference between those indexes. And so when we are picking an index fund, we know what we're owning. We know the pros and cons of those different spaces. So
this is very valuable. I'm learning so many new things that I thought I knew that I don't. So you talked a little bit about tax loss harvesting. So can you elaborate more on that? What does that mean, and how do you help your clients with that?
Yeah, Jody, that's right up your alley.
Sure. Yeah, that's part of my responsibility is handling the tax losses. So for those of you who aren't aware, so what you can do with a portfolio is you can sell a security at a loss and then buy a similar, but it cannot be substantially identical, is the IRS term. So you have to buy something different enough in order for it to qualify it. So you sell something at a loss, you book that loss, and then you can buy something else. What you can do with that loss is you can use it to offset other gains that you have in your portfolio. You can use a small part of it to offset ordinary income, but those losses have value. So over your lifetime, the gains losses are going to be the same, but you can move those losses forward. And so it kind of takes the time value of money and keeps the money in your portfolio instead of having to take it out to pay for taxes. So what we do, so how we approach it is when we pick an index, so say we're going to, we want to use the S&P 500 for our large cap exposure. When we determine which product we want to use and what index we want to use to represent large cap, we also pick a secondary tax equivalent. So what we'll do is we will look for something that's similar to the S&P 500, but is different enough that's going to qualify for an IRS standpoint so that they're not identical. And then so what we do is when we have the opportunity to take a loss in a client portfolio, we can do that. So we typically proactively will do that for our clients. That's a nice service that we offer. So last year is a great example. In 2022, the markets declined. What we can do is we can sell out of that security, that S&P 500 at a loss, and we can move to another large cap index. The IRS rules state you have to swap and remain out of that security for 30 days. And then after that window is closed, you can swap back. So we can sell the alternate index and go back to our preferred index at that point. And that's one of the nice things about indexes. It makes it very easy to kind of maintain your exposure while being able to capture those tax loss opportunities. In active management, it's a little different because you own Apple. There's a reason why you want to own Apple, because you think Apple is going to outperform Microsoft or those other things that you don't own. So last year when Apple declines, are you going to sell Apple? Are you still convicted to Apple? And then if so, what do you buy that's similar enough to Apple? So it's much more difficult for active managers to be able to kind of be proactively tax swapping those different securities because they own Apple for that reason and they don't want to sell it. Where with indexes, it's much simpler and easier for us to kind of swap out those those holdings while still maintaining a similar asset allocation.
Okay, thank you, Jody. So how much of this contributes to the return to your clients on average? Do you have any rough estimate of that, or?
I think I can let Jim chime in, but it's a very difficult to quantify, and it's very client by client. It depends on when that client started. It depends on because where the markets were when that client started, what losses they'll have available. It doesn't show up in their nominal returns, because it's on an after-tax basis. You have those losses, right. So it's very client dependent and what tax bracket they are in as well. So.
Yeah.
Do you have anything to add to that, Jim?
Yeah, the one thing that is a little bit easier to quantify is a key component of what we do is in our philosophy is having a lower fee structure. So index-based investments are considerably cheaper than actively managed investments. So what we've done, if you take a look at a $5 million portfolio, and you look at an 8% annual return on that portfolio, and we look at over different time periods, we're showing two portfolios, one with an average expense ratio of 1%, and then another portfolio with an average ratio of 0.4%. So there's 0.6% difference. Now, on a $5 million portfolio, after 10 years, that expense ratio difference would equate to $565,000. After 20 years, it's 2.3 million. And you can see after 30 years, it's almost $7 million. So what doesn't seem to sound like a very big differential, 0.6% in a given year, the compounding effect of that is extraordinary. So if you layer on top of that tax efficiency and because you're paying less money in taxes, you have more money to invest, that compounds as well. And then the third factor would be avoidance of having a manager who dramatically underperforms, who, in effect blows up. That makes a big difference. To give you an idea of the ubiquitous characteristic of underperformance that we're talking about, this is data that comes from Standard & Poor's. We don't have the December 31st data yet. This is through June 30th of 2022, but they report these data a couple times a year. This shows you the major equity asset classes, and then we show some fixed income and real estate as well. And it shows you the percentage of active managers, again, looking at mutual funds, that failed to beat their benchmark over different time periods. So you can see over a 1-year time period here, if you follow my cursor, the numbers are, not horrible for active managers, but about 55% up to 77% for equities. Percentage of managers underperformed. When you go out longer time periods, though, you get out to 10 years, it's closer to 85 to 90%. And at 20 years, it's about 95% across the board. And the numbers are similar, not quite as egregious when we look at at fixed income and for real estate as well. But the point is that the passive investments do better than active managers, particularly when you look over longer periods of time. So we don't really have, as Jody said, it's very difficult to calculate what that means. What we do know is we are able to look at our results, net of all expenses, and compare it to mutual funds that have a similar asset allocation to what we might have in a particular portfolio. What we show is that the results, net of all expenses, are very consistently well into the top half of the database. And so, that's an area that, of course, everybody would like to be in the top 10%, but that's difficult to do for any kind of sustained period of time. But to be, consistently in the top half, top third, that's a very meaningful outcome, we would argue. Favorable outcome.
Thank you, Jim. So Joseph, I see that you have a question. Anyone who has any question, please type it in the chat box, and we'll try to answer them as we go along. So can you please type your question here if you have any in the chat box, or the Q&A box, I mean, please. Thank you.
Yeah, to tie Jim's comment though on the fees, you know, that is a big differentiator between us and active managers, is that our fees tend to be lower. And really one of the sources of that is active managers. You need a suite of research analysts, very smart people, to go through all of the individual stocks and select, you know, Apple versus Microsoft, Coke versus Pepsi. You know, for you know, the style of our investment philosophy, we don't need a whole suite of analysts looking at healthcare stocks, a whole suite of analysts looking at technology stocks, a whole suite of analysts looking at real estate stocks. You know, because we're looking at more broad asset class level stuff and spending our time on the asset allocation work, you know, we have lower costs at Alesco, and we can pass that along to our clients and charge them less, which works out in their benefit, because it's less of a hurdle for us to overcome by us charging a lower fee. You know, it makes it easier for us to, you know, have those returns closer to the index or be slightly above. So.
Yeah, I'm very convinced to have you manage my portfolio, but I was told by Dean Mazral that you won't touch her portfolio. This is too below your benchmark level, so I'm definitely nowhere near that. But if I have enough money, I'm coming to you.
We
to
look
have
forward
it.
to it. Yep.
Yeah. Okay, I think there was a question, but okay, let's see. We got it here. Jim, can you read that? Can you look at the question?
Yeah,
Okay.
So what's your view when someone states that stocks, companies outperform health funds or mutual? Okay, so yeah, the question is, you know, what we certainly have people that will say, well, you know, wait a minute, I have a manager that you know has done very well, had a particular rate of return that was better than the benchmark over the last 5 years. Well, the first thing I'd say is statistically not a surprise that there are managers that do outperform, and particularly when we look at shorter time periods, we look at 1, 3, 5 year periods of time. The issue really is persistency. So I'm going to show one more slide here that talks about persistency. So we look at managers. Again, this is mutual fund data, and this chart shows on the left-hand part, it shows that the 5 years ended December 2016, and you take the rates of return for the mutual funds and you break them down into quartiles. This top quartile would be the top performing 25% of equity mutual funds over this 5-year period. So then the question becomes, just because you did well over the last 5 years, how well are you going to do going forward? And what you see is that there's very little persistency, that only 13% of the top quartile stayed in the top quartile over the next 5 years. And so, and only 26% stayed in the top half. So the majority didn't even stay in the top half, and 46%, almost half of the top quartile, were merged or liquidated. And that generally is an indication that they had something very bad happen, that they had a significant contraction in their portfolio due to, you know, bad stock picking or bond picking. In this case, we're looking at equities. So persistency is really important. I could hire a 10th grader who could go out and tell me who the best active money managers were, who are the best mutual funds over the last 5 years, right? You know, just hop on Google and you got the answer. So the question is, who's going to perform well going forward? And what this slide addresses is, it's very difficult to look at the past and determine who's going to be the great managers going forward. And that's one of the big charades in the investment business, in our opinion. There's a lot of organizations claim that they have some kind of methodology that allows them to pick the future winners. And we don't we don't buy that. We just think that that's what, is what people want to hear. They're willing to pay a price to an advisor who would claim that they can pick the future winners, but there's really no data to support that. And if you think about it from a perspective of, predicting the market, right, which is really what we're really saying. If you can predict managers, you in effect can predict the market as well. If there was somebody who was very accurate and consistent in their ability to outsmart the market, that person would be a household name right now. We'd all know who they are, and there's nobody who's able to do that. So some of this is really just kind of common sense, and again, from what our view is, pay attention to the work that comes out of academia. Pay attention to the work that comes. A lot of the things we talk about are out of the industry as well, where it's not out of academia. But rather than fight the data, we embrace the data and position our firm accordingly.
Right. So yeah, in academic research also has shown the similar results over time, that mutual funds are not outperforming, and the managers who are successful, do they stay successful in future? So that's a common finding that I have seen as well. So any other questions if you have, just to the attendees, please type it in here. I have one question. Is there any limit? Is there any starting net worth or a range of net worth would you say that this is the point you should start going to the advisors? Like at what point of your life you say, okay, I'm not managing it on my own, I should be going to the advisor? Or is it, is there some starting point limit?
Yeah, so I would say it probably has more to do with looking at things on a holistic basis, because as advisors, we get involved when we're working with high net worth individuals or families. We get involved in talking about a lot of things other than just managing the portfolio, because there's tax planning issues, there's saving for college educations, there's intergenerational wealth transfer issues, there's tax planning, estate planning as well. So those are things, when you get to the point, most people, when they're maybe probably in their early 30s, mid 30s, that's probably a typical age. Things start becoming a little bit more complex. You're starting to actually put some more savings away into your retirement plan. Perhaps you've fortunate enough to build up some after-tax savings. That's a time where you could probably reach out to at least a financial planner, not necessarily an asset manager, but a financial planner, and they can help you make sure that you're making better decisions than perhaps you would be making on your own. That's a really good place. Higher asset levels, when people get to higher asset levels, most financial planners will then refer them on to an asset manager that might be able to provide more expertise in terms of how the liquid assets are deployed in the capital markets.
Okay. Thank you. We have another question from the attendees.
Okay. So is everybody, should I read the question?
Yeah, maybe. I don't know if attendees can see. So I'll read it. So
Sure.
This is a question. I have questioned how much of my income should I invest in the market? Mind you, I'm 21 and I have a substantial amount of money in the market already, and my portfolios are doing well. Are there other ways to invest my money outside of stocks? I trust stocks and good companies. But as a passive investor, which I am, I'm always looking at other ways to grow my wealth. What else is there outside of stocks?
Yeah, so if the investment world is divided into two basic flavors. There's a market of credit and there's a market of ownership. And that's really it. Every type of investment fits into one category or the other. So the credit markets we most commonly think of as the bond market. The bond market is a big credit market. You buy it, if you buy a treasury note, you're lending money to the federal government and they have an obligation to pay you back with interest, right? You buy a bond from Apple Corporation, it's the same situation. They're going to pay you interest and pay you back your principal over time. So then there are the equity markets, the market of ownership, right? So we think about the stock market. So based on how the question is asked, I believe that they're looking for alternatives to stocks, and there are many alternatives. So we think about its markets of ownership. Probably the biggest other type of equity ownership investment would be owning real estate that would not be publicly traded real estate. So you would, a very good investment for most people is investment in their own home. Buying a house, being there, and you have a couple of advantages of it. One, it's a place where you can hang your hat, right, and keep the rain off your head, and so you get to enjoy that. But generally speaking, the pricing for a personal residence will appreciate over longer periods of time. So that's another option. It'd be a very good, because of the other advantages, as I mentioned, very good utilization, very good place to put your money. But there are also all kinds of other private investments that are available. And so those private investments can be putting money into some kind of private equity fund, a venture capital fund, a private equity fund, an angel fund. Those are generally much higher risk, much riskier investments, but have the potential to generate higher returns as well. When you think about the person who asked the question is just 21 years old, but if they have a long time horizon, they may think about taking a portion of their overall investable asset pool and allocating it to some higher risk, higher returning investments. My primary advice in that regard is make sure you're diversified. You're much more likely to have a favorable outcome if you're putting money into those riskier investments that if it's a diversified investment versus as I like to say, putting all your chips on 36 black at the roulette table, right? It's great if 36 black pops up and you win, but if it doesn't, which is a much more likely scenario, you lose everything. And that's what happens if you just put your money in one particular company. So the basic rules of diversification in terms of stock investments, passive investments hold true. Try to keep your costs low. A lot of private equity investments are not cheap. So keep your costs low and be diversified. And also tax efficiency is very important as well. I'm assuming the monies that are being invested are taxable dollars.
Thank you, Jim. So does your firm venture into the commodities as well, in the oil, gold, things like that?
We look at commodities as an asset class, and we look at it really on a broad basis. So we would if we have invested in the past, we don't have any direct commodity investment right now. But so commodities we would look at. There's another, Jody was talking about how the different indices, different benchmarks are created. Commodity benchmarks, you could find some of these benchmarks that are 80% energy, 80% oil, not just energy. And then so so you really have to know, you got to look under the covers and understand what you have. But so commodity investment that we would be interested in would be one that has exposure to certainly energy, which is the biggest part of the commodities market, but also industrial metals, precious metals, agricultural products. That kind of more broader based commodity exposure would be something that we have invested in the past and would look to invest in the future.
Okay. Thank you, Jim. I want to be mindful of your time. It's 1 p.m. So there is just one question, SQQQ. How many companies are represented in this ETF? Again, that's we can look it up. We can answer that later. No worries. So you can again, to be mindful of Jim's time, I'm gonna let him go, and I can stay for a couple of minutes. And Matt is here if you have any other program-related questions or any other finance-related question, I might be able to answer. Again, I don't know how Jody's schedule is. I just wanted to give you the option, Jim, to
Yep.
be able to stop
Why
it.
don't,
Yep.
I'll stay on, we'll address the two questions that
Okay,
are
that
out there
sounds
right
good.
now, and then,
Yep.
I'll hop off. And Jody,
Okay.
I don't know if you know the answer to the QQQ question. I don't.
Yeah, so the QQQ, there are 100 companies in the QQQ index. If that tracks the NASDAQ largest 100 companies. The interesting about that is the criteria is based on NASDAQ companies. So they do limit themselves to that exchange. And so because of that, you end up with some very large companies. You end up with, the largest holdings are like Microsoft and Apple at around 12% each. So it does end up somewhat concentrated. So you get, half of your assets are in the largest 10 holdings, where if you compare that to something like the S&P 500, there's only 20-something percent, 24, 25% in the largest 10 holdings. So it is more concentrated. It's something a little bit more specific. But if that's what you're targeting, it's just knowing what you own and understanding what the fund is trying to do. So if that's your goal, then that can be a great product to achieve what you're looking for. So.
Okay.
And then the second question was how many positions would we recommend a more sophisticated investor have with the one who has a long-term investment horizon? Jody, I'll take it.
Yeah,
You, Jody, you definitely should answer that.
Oh, no problem. Yeah, so it does change over time. So we do add asset classes and remove asset classes from time to time. But we typically have probably between 14 and 18 different products. It's really how you carve up your space. So we tend to have, a large cap index, a mid cap, a small cap, micro cap, which is smaller than small cap. It's the smallest of the small. And then we have some tilts. So we also believe in having a value tilt. So we do have some value funds as well on top of that to give us a slight overweight to value. And then we carve up the international space. We like to kind of have some control over our developed and emerging. So that way, if we see some severe dislocations and some opportunities there, we can move money between U.S. and developed and emerging companies. And we have value and small cap products in developed and emerging to try to capture some of those premium. And then in the fixed income side, we'll have 2 to 4 fixed income sleeves over there. The largest position generally is the aggregate, which is the broad U.S. bond market. It's investment grade. It's got securitized corporates and U.S. treasuries in it. And then we can do tilts off of that to over or underweight particular sectors if we feel there's a dislocation there, or duration. So we can put on or off duration in order to kind of control our interest rate risk as we see things move over there. So even though we are predominantly using index products, we are kind of active in our asset allocation, making those decisions and coming up with that asset allocation for our clients, and then looking for opportunities to tactically shift between those in the long term.
Yeah, and then so the individual is asking a question as a student in our IT probably doesn't have multiple millions of dollars to invest in. So let's say for the sake of argument that one has $1,000 and is looking to invest. One of the great things about these index funds is they're broadly diversified. So if let's say you had $1,000 and you wanted to be 70% in equities and 30% in bonds, if you put 70% of your money into the Vanguard S&P 500 fund and you put 30% of your money into the Vanguard Total Bond Market Fund, your results over the next 5 years are going to be way better than most investors do. That's part of what we're talking about. So you don't have to have a whole series of
we got the number, Jim, 100K.
Okay. Yeah.
Yes.
So you multiply that by at 100,000, there you probably would be. We would argue that you still keep it very simple. Probably keep the same bond positioning, although you might want to look at maybe a little bit of diversification there. But to own the Bloomberg aggregate, or the Vanguard Total Bond Market Fund, and then the 70,000 that you're going to put in equities, a very nice allocation would be to take half of that, so 50% of the 70%, 35%, and put that into the S&P 500, and then split the other half between, I would say, split the other half between small cap stocks, a Vanguard small cap index fund, and then the remaining in an EFA, or a Europe, Australasia, Far East international equity fund. That would give you really tremendous global diversification. You without being overly complicated. You would only have 4 different investments, but it would be a very robust allocation, and you'd serve yourself very well. And it's also, because it's simpler, it'd be very easy to maintain.
Thank you.
It's very scalable.
Yep. Okay. Will it be?
The
Yes,
key thing,
yes, we are recording this session, and the recordings will be posted.
Okay.
I don't know
Just
where
wanna-
you hear the, yeah, sorry, go
I
ahead.
have one caveat that I want to say, because I'm giving some relatively specific advice. This assumes that the money can be invested for a long time, which is what the person who asked the question had said, that if you need money to, as I said earlier, to pay the heat bill next month, that shouldn't be in the stock market or the bond market, right? So this is for longer term investors, and let's define that for, let's say, 10 years or more, that you can have the monies invested. If anything less than that, you shouldn't really be in the stock market.
Thank you, Jim. You are such a wealth of knowledge. I can keep talking to you. I have so many follow-up questions, but again, to be respectful of your time, thank you so much to both you and Jody for being here and answering our questions and so on. So Matt and I are going to stay. If you have any other questions about the program, or any maybe some easier question that I can tackle, but I would let Jim and Judy leave at this point. Thank you so much. Really appreciate it.
Thank you. Good to be with you today. Thank you.
you.
Bye-bye. Thank you.
Bye.
Thank you very much.
Yeah, 20 years is what you're thinking. That's a good long-term investment time frame. So that's good. Okay, any other questions regarding the program? We have, as we said, this webinar was brought to you by the Accounting and Finance program, Masters and Undergrad. So if you have any questions related to those programs, please feel free to ask them now, or you can email Matt later on too as well. So we'll stay here for another minute or so to see if anyone has any other questions. Matt, oh, sorry. The question is, does RIT have courses on investing? Yes, we do. So we do offer both undergrad and grad investing courses. So you will learn intermediate investment, and then in your undergrad program at the master's level, we have a basic investment securities and investment analysis course. Then we also have specifically equity analysis course and debt analysis course, risk management, and all those types of courses. And we also have a personal finance course for those who are not interested in necessarily the finance discipline as such, but if you want to learn about the basic investment, we have personal finance course as well. So again, to complete that, it's Finance 120 would be the personal finance course. If you're not a business school student, you might be interested in looking at that. Okay, I guess we'll wrap it up here. If you have more questions, feel free to reach out to me or Matt regarding the program. And thank you very much for attending the session with us today. Okay, Matt, you can answer this one, I guess.
Yeah, Joseph, I know we've connected quite a bit in the past. The EMBA is for students that have significant work experience, so you'd be looking at the +1 MBA. Just given your interest in finance, though, you could certainly focus your elective courses on finance. Or if you do want to think about the MS in finance as well, that's always an option. So there's different ways that you could tailor what you're looking at to what you want to accomplish there. But the EMBA is specific to folks that have at least 6+ years, and I think the average is 12 to 13 for those students.
Thanks. Okay. Okay, thank you so much. We'll end it here, and looking forward. If you have any questions, please send them our way. Thank you, Matt.
Thank you, everybody.